It has been almost 6 months since the lockdown, and schools are set to reopen in September. Where do we stand in terms of our economic recovery? What is the outlook for the Toronto housing market for the remainder of 2020? Let me share 3 important recovery updates with you. Number 1, the job market. As of July, we have already recouped about 55% of the 3 million job loss since the lockdown. It is also interesting to note that the number of Canadians working from home dropped by 400,000 in July. You see, youth, students, and low-wage workers continue to be the hardest hit groups. Number 2, the immigration level. In April, we only welcomed 4,000 permanent residents to Canada. In May, the number almost tripled to 11,000. And in June, the number increased to 19,200. That's 56% of the number in June last year. We are still waiting for the July and August numbers. But you see, the much stronger number in June is telling us something important. Canada continues to welcome immigrants during the pandemic, and even with the travel restrictions still in place, a lot more people are now able to overcome the COVID challenges and complete their PR landing in Canada. Over the next few months, our immigration department will be expecting the same range as June, around 20,000 permanent residents per month. Once the travel restrictions are lifted, we can expect to see another increase in the number, as our immigration minister has repeatedly stated that welcoming high levels of immigration will be key to our post-pandemic recovery. Number 3, the economic growth rate. With all the reopening efforts, how are we doing in terms of economic activities? The average forecast of Canada's Big 6 banks are expecting Canada's economic activities to rebound twice as fast as the United States in the current quarter, with an annualized growth rate of 36% for Canada and only 20% for the United States. With the surge in employment, surging house sales, and gains in credit card spending, BMO Capital Markets estimated that the Canadian economic activities has recovered to about 95% of pre-pandemic levels. This number seems a bit surprising. You see, the impact of this pandemic is very complex. While some parts of the economy are weakened, the weakness is not shared equally. Some industries are actually booming, such as online businesses. On one hand, many smaller corporations and small businesses such as corner stores and restaurants are going down. On the other hand, companies with solid base and a strong cash flow can borrow at historical low rates. What does that mean? They are actually taking the opportunity to stock up on assets and buy out smaller companies that can survive the pandemic. That's what successful companies do. When other people contract, they expand. The same thing is essentially happening in the housing market. Banks have tightening their mortgage requirements. But if you are eligible, you can get a mortgage rate at 2% or even lower. You see, that's the trouble of cheap money. It tends to go to people who need it the least, especially so during a crisis like this, when people are in danger of losing their jobs and businesses. People who can take advantage of the low mortgage rates tend to be people with solid financial backgrounds and stable jobs. That's why, even though the rental market has been slow, both sales and prices for properties in Toronto were up significantly in July. If you haven't watched my video on the July market report, you can watch it at the link in the description below. You see, as the impact of the pandemic spreads, the gap between the rich and the poor is widening. Some businesses would die and disappear in this pandemic, but other companies with strong cash flow or deep pockets would step in and pick up valuable portion of these dying companies. Just as in the housing market, people with strong cash flow or deep pockets would take advantage of the low interest rates and stock up on assets. And people who are most affected by job losses are people who weren't ready to buy real estate anyway. So, the Toronto housing market is expected to remain as a seller's market with low inventory supply and high demand for the remainder of the year. In terms of price, the latest report from RE/MAX estimated an average increase of another 5% for the remainder of the year. If you are one of the capable ones who can take advantage of the cheap money, the opportunity is here. The rest is up to you. When you are ready to take action, you can schedule a call with me and I will help you become a true investor and grow your portfolio during this unprecedented time. Make sure you subscribe and hit the bell so you stay on top of the market.